Joining us, Jonathan Golub. He is the chief U.S. equity strategist, and David Stockman, former Reagan budget director. Jonathan, first to you. Overall, with this sell-off, this pullback, your assessment of it, because the big question people are asking is, now's the time to buy?
But the short answer is this is one that you want to buy, and the key issue is that there's no smoking gun. There's no news item. There's nothing new that's happened over the last 2 or 3 days that tell you that it justifies this sell-off. And until you have some reason to not want to be in this, the
ironically, though, doesn't that make it a little more worrisome then? That everything is so great and all of a sudden the market falls through the trap door?
Well, not really. I mean, corporate profits are going to be up over 20% this year. GDP, the economy is going to grow at about 3%, which is really robust. The U.S. looks stronger than any other market. We're the only place in the world that has a really large and robust tech sector. Markets don't go up in a straight line, which I wish they would. So if it's down for a reason, that's one thing. If it's just noise, then I think you buy it.
All right, David Stockman, my man. You kind of saw this week coming, but this is probably, in your mind, just a precursor to something much worse.
Yeah, I think it's a wake-up call. It's telling us the fantasy is ending. We're going to have to get back to reality. You know, I don't buy this thing that the economy is strong. We've had 1/4 of 4%. Obama had 3/4 of 4%. He had 11 quarters of 3%. But on trend, the economy is weak and it's old. We're in month 111 of this recovery. They haven't abolished the business cycle. We're 8 months from the longest in history. In the next year or two, there will be a recession. Earnings won't be $160 a share or $170. They'll be $75. This market is massively overvalued. And people are simply getting in harm's way if they take the bait this morning. Yesterday and the day before told us something. Last night, you know, the trading moths went for the light bulb. We ended 40 points below the 200-day moving average on the S&P. At 2 o'clock in the morning, they were back at the 200-day to see if they could get any suckers to come in and take the bait. And the home gamers may take the bait or they may not. If they got any sense, get the hell out of the casino because it's going down, and it's going down big.
So let me bring Jonathan back in the conversation. The only thing keeping this thing going is the greater fool theory. and I guess easy money
I don't believe that I'm actually going to debate the great David Stockman on the market, but I'm going to take the other side of this. First of all, you talk about the market's expensive. When something goes up, and when the stock market goes, and it's all because of earnings, not multiples, that's not an expensive market. That's just a robust market. The stock market is trading at right now less than a 16 multiple on a forward basis. That is historically more like average than it is something that's said. That's first. Second, there's a bunch of really useful indicators that say, are we likely facing recession in the next 12 to 18 months? Whether this goes on for 2 years or 10 years, that's harder to tell.
That flattening thing, then, that didn't scare you when we almost flattened the yield curve?
And by the way, that it is absolutely a good signal. And it says once you get flattened, once the yield curve flattens, then you have about 12 to 15 months before you begin to have a risk. So that means, yes, a flattening yield curve could be a risk 18 to 24 months from now. And the same thing, you have employment. You've never had a recession in the next 12 months where the employment picture is this robust. So there's a variety of signals.
David, I don't remember 11 quarters above 3%. I'm going to have to check my records on that one. But
believe me, it's true.
But I will say that the last couple of years,
what, 32?
I'm not. Saying,
no, I'm saying coming into the Trump administration in 2016, I think the last 2 quarters were 1.9, 1.6. Yeah. We were listing, right? We were certainly lumping along. Something has reinvigorated the economy. I think you'd have to admit to that.
No, there was just a global commodity cycle. The market peaked and boomed in 2014. Earnings on the S&P came in at $106 a share. Over the next 2 years, oil prices went from 100 to 25. The whole material sector, the energy sector went down.
But shouldn't that have been a boom for consumers and on the other end?
The point I'm making is earnings fell all the way to $86 a share. Nobody noticed the 18% decline. We've recovered that now because the commodity cycle has come back. China had a temporary surge when they were coronating their new emperor. That's all behind us. This is a global cycle of short-run nature, and what we're doing is piling on massive debt way at the end of a business cycle.
Let's bring an EMAC in.
We love you, right?
Yeah.
Have you sold all of your stocks?
Yeah.
You have not.
Yes, of course. This is
When Trump was elected?
Because I'm not a market timer. If you're a market timer watching
Well, you
it by
missed out on massive run-ups. Then.
Well, wait a minute. If you're a market timer and you're watching it by the day, be my guest. But if you're a investor,
when did you sell all your stocks?
I haven't been in stock for years, and I should.
When did you sell?
But
you know, I'll give you the.
I will say
like.
this though, David. I mean, listen, you're a brilliant. You're a brilliant person. But you've been negative for a long time.
Of course, I have.
Our viewers who've watched and said, "Okay, I'm going to wait until David gets positive," have missed an extraordinary rally. Also, the time that comes with that. I mean, you know, we can't discount. We don't get back 9 years, right?
Yes, we do. We take it back dramatically. In March 27, 2000, the NASDAQ 100 was 4,700 points. 13 trading days later, it was 3,200, down a third. And 2 years later, it was down 83%. People got massacred. It happened again in 2008. What I'm saying is
there's a big difference on these.
No, this is a phony.
But the difference is that the tech companies of the late 90s, which is really what you're talking about, were companies with no earnings. They were speculative names. And if you look at the Googles and the Facebooks, the Apples, these are companies with great earnings, great profit margins, huge addressable markets, online advertising, online retail. So they're not. They don't resemble.
That's what they always say. But look
how many of us use cell phones. Look how many of us are getting Amazon package delivered to our homes. That's not the same picture that you had in the late 90s.
Yes, it is. And let me say that in 2008, the S&P 500, which had nothing to do with eyeballs and tech and all the rest, declined 55% in a year.
But you can be in one case you're comparing it to 2008, the other you're comparing it to the late 90s. And so, which period are we looking at?
I'm taking both of them. I'm saying markets are false. They're fake because they're inflated by the central bank, by the massive money printing, liquidity injection.
So
wait a minute. Now they've pivoted.
Let's fast forward because
they're shrinking.
They're doing quantitative tightening now.
Yes,
$50 billion a month, and they're raising rates. So they're doing what you want them to do. They're pulling this liquidity out.
And that's why the bubble's going to collapse. For the first time in 30 years, the Fed is draining massive liquidity out of the bond market. When Greenspan went in, and this is important.
Yeah, but there's still the liquidity was still in there.
But we're making the assumption that the only reason stocks go up is because it's printed money that just flows in, as opposed to these are really great companies that are generating jobs, they're generating profits, and ultimately that's what you're buying.